for those kind words, introductory words. I want to first of all start on this notion of trust and reliability that was mentioned by all speakers, in particular by Philippe Steinberg. And I have to say, in the current campaign that we are running right now in France in the context of the presidential elections, this is something that we very much care about. We hear strong dissensions between those who believe that the trust between the French and the Germans should be respected and boosted, and you have those that do not. And I really hope that my country will not blow the euro area up in the coming months. Having said that, coming back to themes more related to investment developments and macroeconomic developments, which is probably easier to handle in 10 or 9 minutes, I will first say a few words about the macroeconomic scene in Europe to say what has improved and what makes things easier. Then I will link that to what I believe, as of today, are the prerequisites for structural improvements in potential growth, which is related to investment developments. And then I will focus more on Southern Europe and Greece. And then I hope I will have enough time to get there. But in terms of the macro picture in Europe, we know now that, and things have been confirmed, hard data has confirmed, soft data, the growth environment is a lot more supportive than it was a year ago. We know that inflation is coming back to levels that are more or less in line with the ECB mandate, at least for what concerns headline inflation, not so much core inflation, but we do have a stance in terms of fiscal policy that is turning more supportive to growth. We have had a couple of hard years in terms of growth reductive fiscal stance. Now this is not the case anymore. That's true for Europe. That's also true worldwide. So the policy environment should become more supportive. And in the euro area, monetary policy remains incredibly loose. So I say it is very loose in quantitative terms, in interest rate terms. And some believe that it could have been, it could become to be tighter. But we are in this, sort of a transitory phase where fiscal stance will help and monetary policy does not withdraw support yet. So we have a fairly, improving, I'm not saying much better, but improving environment that should be benefit from a supportive policy environment. Now, this happens against the background of, and this was discussed in the previous panel, of bank weaknesses. We have, I would summarize it as saying we didn't have TARP in Europe. So the banks are in the states we know today. But there's also lots of debt around in public and private balance sheets, and we have to deal with that. And I'll close with a few remarks on this relating to what Mr. Belka said in the beginning. The second issue or factor that weighs on growth development is productivity. And in fact, we are probably not the worst in the world in terms of productivity developments, but we're not great either. And here, there's one thing which is even more striking than before, is that there's a huge productivity divide between the North and the South. When you look at firms and the distribution of firms along one variable which is useful to economists, which is total factor productivity, when you look at those firms, you would see that in cutting-edge countries, I have in mind Denmark, Sweden, Austria, you have only 5% of the firms that are in the last quintile of the TFP distribution. So all firms in those countries are really leading total factor productivity. Less than 5% in those countries, more than 60% in countries like Slovakia, Bulgaria, Greece, and Poland. So that's an issue, and that's an issue where we do not see things converging. So that's something we have to keep in mind when we think about the profile of investment that we want to see flowing, in countries and from one country to the other. A third weakness has to do with potential growth. Now, potential growth is everywhere improving, but it's still very weak. It's turned up, but it's still very weak, and it's a lot weaker in some countries than in others. Now, if we look at potential estimates of potential growth for Greece, they are fairly negative. I mean, you have a range between -2 and -3. I think we are on the negative side of it, but still an output gap that is following that low potential growth. Against this background, and given the history of the history of investment developments that Philip mentioned earlier, we have identified massive investment gaps in some areas, one of which, when we did that at the EIB, the one that comes at the top is education. Then we have energy, ICT, R&D. So all those things that sort of improve the productivity of your factors, of your capital stock, and of your labor. So here there's a lot to be done in terms of where to invest. Now, what are the impediments, or what would be the prerequisite for to have a structural improvement in potential growth, and therefore for investment to be really growth enhancing? To answer that, I will use some data that we just collected from EU firms. We have conducted a survey at 12,500 firms across the EU. So we came to Greece as well, and I will give you a few numbers on Greece. We haven't published it fully yet, but we are giving a few numbers away. And when you ask firms, EU firms, whether they invest abroad, so one precondition would be to have risk sharing, and if you can't have risk sharing on the public sphere, you would need to have risk sharing on the private sphere. And if you ask firms, so non-financial corporations, whether they invest abroad or not, basically they do not invest that much. A bit more than 10% of their investment is done cross-border. That's nothing. It's a lot more, again, for Nordic countries, like firms in Denmark, Belgium, the Netherlands, they invest 3 times as much, but still you have a huge divide. So no risk sharing on the private level, and this is clearly a condition sine qua non for potential growth to improve, at least in Europe. Now, there's also the question about the state of the capital stock. Do we have a capital stock that is old, or does it need to be replaced? Do we need to expand capacity? Do we have the feeling, do firms have the feeling that they have state-of-the-art technology? And here we realize that firms are still investing, so they don't invest that much, but for what they use, the way they use their investment is massively to renew the capital stock. So again, you have some countries, in particular Eastern countries, that have part of their capital stock being very cutting edge because there have been new investment flows, but the bulk of investment, more than 50% of his investment, is to replace the capital stock. And if you ask firms whether they are going to continue replacing the capital stock, they say yes. So is it a good news? Is it bad news? You may say it's good or bad, but I mean, it's good because if your capital stock is too old and you need to invest, then you do it. But it's bad news because, as long as you haven't done it, it's not, that helpful for you to improve your productivity profile. So I would tend to look at it the positive way and say, once we have, invested, and once we have a capital stock that is cutting edge, then our productivity developments will be better, and therefore we will have a better potential growth, and that will improve growth in the long term. Now, a third sort of a precondition to have an improvement in potential growth through investment is that the constraints to investment that we see right now can be jumped over, that they are not too structured. And here, and that's why I will turn more to the Greek context in a moment, but most of the firms in Europe told us that the main impediment, and that's something that was identified already, the main impediment to investment is uncertainty. Uncertainty of all types, general economic environment, policy uncertainty, and also regulatory uncertainty was a big thing. In many countries, not in this country, but in many countries, the availability of staff with the right skills was as much of a constraint as uncertainty. That was very much the case in Germany, for example. So you have this coming back to this complementarity between investing in education, investing in infrastructure, and investing in softer capital stock. And the third constraint that I would like to highlight is the availability of collateral. So you have a number of firms that would like to invest more, but they do not have the appropriate collateral to get external funding. And when looking at it, it's probably more a matter of those firms that have, what we call intangible collateral, software, human capital, things that banks do not like when they are looking into giving you a loan. Now, generally in the EU, finance is not a constraint, so they shouldn't need us, the EIB, because there's a lot of money around. But in Greece, that's where there's a big contrast with other countries. So here, what we find is that companies are eager to invest, so they would really be willing to invest. Surprisingly, they invest a fair bit in intangibles services. So this is also good news in terms of moving to things that are sectors that have higher value added. But the main impediments are the political uncertainty, regulatory uncertainty, and availability of external finance. So here there really is a strong case for policy action, the correction of market failure. Now there's a lot of internal finance in Greek firms, so they use more than 80% of their financing come from themselves. And in that 20% that remains, a lot of it is really coming from banks. So does it mean we need more in Greece, more equity investment, venture capital? Probably yes, but generally external finance in general, even in the form of loans, would be very useful. I mean, now the EIB is very much involved in Greece. If you looked at our aggregate exposure to the country, and it's in many percentage points of GDP. So we're really helping, or we're trying to help. We're mostly present in the transport sector, in urban infrastructure, and in energy. A little bit on SME financing through banks, but that would be more or less the profile. So overall, I think we are now slowly getting the macroeconomics of investment more clear. So we come to a point where we know what to do and what is less needed. Now it's also a matter of getting it through to the political agenda. And I think, I know in this country it's not easy, and the whole discussions that we've heard in those few days shows it. But it's also a matter of linking that to moving forward on the European level. And here I think it's a matter of responsibility of all countries involved, including and perhaps starting with the main core countries. So.